I am Revanny ZALYTHA with NPM 244122020 Class Act 24A. Accounts receivable, or accounts receivable in Indonesian, is a crucial element in a company's accounting cycle. Accounts receivable represent the amount owed by customers to the company for sales of goods or services made on credit. This means the company has delivered the product or service to the customer, but payment has not yet been received immediately and will be made at a predetermined time, usually within 30 to 90 days. In financial statements, accounts receivable are recorded as part of current assets because they are expected to be converted into cash in the near future. Effective management of accounts receivable is crucial to a company's financial health, as accumulating or uncollectible accounts can disrupt cash flow and even lead to losses. The process of recording accounts receivable begins when a company sends an invoice to a customer. The amount of this invoice is then recorded in the accounts receivable account. If a customer makes a payment before the due date, the company records a payment and reduces the relevant accounts receivable balance. However, if a customer fails to pay on schedule, the company needs to follow up by collecting the debt, or in some cases, setting aside a portion of the receivables as a loss due to the possibility of uncollectible accounts. Using reports such as aging schedules is very helpful in monitoring how long receivables have been delayed in payment. The longer receivables are delayed, the greater the risk of them becoming bad debts. Overall, accounts receivable reflect the trust relationship between a company and its customers. Therefore, in addition to good internal management, assessing a customer's creditworthiness before granting a sale on credit is also an important step in minimizing the risk of bad debts. The estimated bad debt is usually calculated based on a certain percentage of the outstanding receivables balance or based on the aging of the receivables. The longer a receivable remains unpaid, the greater the likelihood that it will be uncollectible. Therefore, companies prepare aging schedules, which are reports that group receivables based on the length of time they are late, such as 0 to 30 days, 31 to 60 days, 61 to 90 days, and more than 90 days. Good receivables management will help companies maintain liquidity and avoid cash shortages that could disrupt operations. Some common strategies used by companies include establishing strict credit policies, conducting credit evaluations of potential customers, providing incentives for early payment, e.g., cash discounts, and using third-party collection services or factoring. In addition, companies must also consider the impact of accounts receivable on financial ratios, such as the receivables turnover ratio, which measures how quickly a company can collect its receivables within a given period. This ratio serves as an indicator of the efficiency and effectiveness of a company's credit management. Thus, accounts receivable is not just a number in the financial statements, but an integral part of the business strategy that reflects risk management, operational efficiency, and long-term relationships with customers.